Hello and welcome to a special episode of IPO KYC. Today we're in conversation with the management of Vishal Mega Mart. Well, this is a mega IPO. 8,000 crore of the IPO size. This is a pure offer for sale. The company is 100% PE backed. Kedara Capital, company called Samayat Services will be paring down their stake. Why this offer for sale? And with this stake comes down from near 99 to 76%. In conversation right now with Gunender Kapur, the CEO of the company. Gunender, thank you very much for joining in. So the first question is, right, it's a large offer for sale. Why?
Firstly, the promoter stake is coming down from 98.77% to 76.02%. And I must say that they would continue to be the promoters and one of the large shareholders in the fullness of time too. They have a long-term commitment to the business. Now, as you know, we are largely private equity owned. So therefore, and private equity investors have been invested now for over 6 years. And therefore, this is just a dilution of this stake and an effort to make it a publicly listed company. And
but PE companies have a fund life.
Sure.
So there is always a risk of further supply coming through. So what is the commitment from the Kedara group?
That's absolutely correct, Reema. And therefore, we've been very upfront with all the potential investors that Samayat will continue to be a promoter of the company. And the private equity investors have a long-term commitment to the business. They're very excited about the future of this business. And therefore, there should not be any significant concern on that front at all.
They invested way back in 2018 at a valuation of 5,000 crore rupees. Now the valuation is 37,000 crore rupees. That's a big jump that we've seen in 6 years.
Yes, by the grace of God, the business has performed very well. We have shared some numbers and they will all be in the public domain very soon. The company continues to grow at double-digit same-store sales growth. For example, in FY24, we grew at 13.6%. In terms of same-store sales growth, with a revenue of about 8,900 crore rupees. We achieved an EBITDA margin of 14%. We achieved a PAT margin of 5.8%. Our return on capital employed was 71%. And if I may just take a slightly longer period from FY22 to Q1 25, the company has generated free cash of close to 29 billion rupees, which is almost like 3,000 crores. We are totally debt-free. We have cash on a balance sheet to the extent of 700 crores. So, yeah, I would say God has been kind and the company has performed well. And we have a very long white space and roadmap to growth. And we see an exciting future for the company.
So let's just talk about the near term, because off late we've seen some sort of consumption fatigue coming through, slowdown. So are you confident, at least in the near term, the next 12 months, that the numbers that we've seen so far, a 19% revenue growth in H1 or a 13-14% kind of same-store sales growth will continue, say for the near term?
Reema, all I can say is that in the first half of the current financial year, as you mentioned, we have achieved a same-store sales growth of 12.6% and a PAT growth of 30-odd%. So we continue to perform well. We don't give forward-looking guidance.
But are you seeing a consumption fatigue?
I'm seeing some pressure on consumption. We've seen that in the first half. And I would say that we've had to do more to get double-digit same-store sales growth. But we are confident about the future.
So when you say you had to do more, was it more discounting? Was it more spending on marketing? And I mean, what did you do to ensure a double-digit same-store sales?
I think the most important thing that we do is to ensure that we make people's aspirations affordable. So depending on what the inflation is and how the economic scenario is panning out, we ensure that we fine-tune our offering to the customers to make sure that it stays affordable.
Okay, so is fine-tuning offerings a very nice management jargon for discounting, increased discounting?
Well, I wouldn't quite say that. It's specifically to say that if there is inflation, as I mentioned, and there could be price growth in the market, we are very sensitive at that moment because we research it with our consumers, be absolutely certain that they are feeling good about their future at that point in time. And if they are feeling a massive impact of inflation, that quite specifically we would defer our price growth.
You would defer price growth.
Like
that
we've done in the first half.
Okay. But there will be a margin impact when you do that. When you absorb the inflation.
There could be at some points in time. For example, when the Ukraine crisis happened, the inflation on the input side was very significant. Not right now, it's quite benign, I would say, compared to that. And even in that situation, we felt that with the increase in food prices, our consumers and customers were really struggling for a short while. And we did not take a price increase, and we took a hit on our margins.
Okay. And in H1, you've deferred a price hike, you said.
I'm saying it's things like that. So it's not just one thing, which is discounting or marketing.
Okay.
It's even, for example, things like price growth. So it's a combination of all that. And indeed, when our customers are facing a challenge, we find that they buy more of our private brands and less of third-party brands because our private brands offer significantly better value at the same or better quality. So we see that happening in our stores at times.
Okay. So Gunender, we have your numbers for the last 3.5 years now.
Sure.
So margins have largely between 13 to 14% at the EBITDA level. Gross margins broadly around 28%. Has that been the long-term trajectory? And do you think over the longer term, minor fluctuations here and there, investors can expect this kind of
without being specific, I would say yes.
Okay.
I would say that our general view on gross margins is that we would maintain them at the same ballpark.
Okay.
And we may get growth on our EBITDA and PAT because of the operating leverage that we will enjoy. As you've seen historically, we grow at double-digit same-store sales growth. And if the cost inflation is around 5, 6, 7%, then we do benefit from the operating
So when Kedara
leverage.
took over in 2018, what were the operating margins, if you remember? I mean, how have you scaled it up over a longer term?
I wouldn't quite remember the numbers, but we've been growing our operating
You've been
margin.
growing the margins?
Yes, please.
Okay, with leverage coming through.
Yeah.
What about the contribution of your own brands? That has gone up. In FY22, the number was 70.2%. It's come to 72.86 as of the first half of this year. So despite this number going up, your gross margins or your EBITDA margins have remained the same. Why is that? Shouldn't you be getting higher margins on your own brands?
So you're absolutely right. Our private brand contribution is amongst the highest in retail in India and in some cases all over the world as well. For example, 100% of our clothing is private brands, 70% of our general merchandise is private brands, and 33% of FMCG by value is our private brands. And as I mentioned, they play a very important role of ensuring that we make aspirations affordable. So that's the key goal there. And in many cases, the gross margin in terms of rupee per unit could be the same or slightly better than the third-party brands. So that's generally the approach. But then what we also do is that we invest at times in pricing, as I mentioned, by not passing on the inflation. So the general plan is to maintain the gross margins in that ballpark. And there would obviously be better efficiencies in sourcing as we sell more and more. And we would ensure that we use that to cushion our customers for any significant inflation.
So Gunender, I know pricing is not a science, it's an art. But would you broadly say that the focus of the company is more on ensuring that double-digit growth continues? Because value to the customer appears to be the core goal of the company. So in that attempt, you're willing to take a hit on margins, but do you want to make sure that the customer has value and you will get a double-digit kind of a growth at the top line? Is that a fair way to assess the company's plan?
I would say that that would be part 2 of the plan. Part 1 is clearly the mission of this company, which is to make people's aspirations affordable. Now, as you know, the internet penetration in India is now close to 1 billion people. And therefore, one immediate consequence of this is in the fact that the aspirations of less affluent and the more affluent are somewhat converging, because they have access to the same content. They are exposed to the same things. And that's in some ways a bit of a challenge for the less affluent people because they can't afford those aspirations. So our goal is to make those aspirations affordable. And the first step in that process is to ensure that we sell merchandise which is aspirational. And not commoditized. So the reason we have 72 to 74% share of private brands is because we develop things for our customers to meet with their aspirations in a very dynamic fashion. And these are constantly changing. So I would say the goal number 1 is to make their aspirations available. And goal number 2 is affordable, which you pointed out.